Welcome to our deep dive on the very high cost of living dilemma. When financially secure families trade investment wealth for lifestyle proximity. In this video, we'll explore whether a $1 million home in a VHCOL area is not just affordable, but intelligent. We'll focus on net worth versus cash flow, stress testing income drops, tax-smart funding, and ultimately the trade-off between wealth optimization and life satisfaction. Let's start by laying out our agenda and the decision framework we'll use throughout the episode. Here's the roadmap for today. We'll begin with why VHCOL areas are attractive, then move into the critical distinction between net worth and cash flow risk. Next, we'll cover tax-smart funding approaches for down payments. After that, we'll stress test an income drop against elevated housing costs. We'll then discuss the ultimate trade-off between maximizing financial returns and maximizing life satisfaction. We'll apply everything with a concise case study and decision framework, and include short quizzes along the way. Let's begin by understanding the pull of VHCOL living. Many families are drawn to VHCOL areas for a compelling mix of superior schools, world-class amenities, walkability, and family proximity. However, these benefits come with high and persistent costs: property taxes, insurance, maintenance, and the often overlooked opportunity cost when capital is tied up in a primary residence. With that context, let's transition into the most important financial lens for this decision: net worth versus cash flow risk. The central idea here is that financial resilience is primarily a function of net worth rather than current income. For households with multi-million-dollar portfolios, liquidating between $500,000 to $800,000 for a down payment can be reasonable if $3 million or more remains invested afterward. However, the source of funds matters. Prioritize taxable brokerage assets to avoid early withdrawal penalties and potential tax traps in retirement accounts. Maintain 6 to 12 months of cash after closing to provide shock absorption. This structure reduces ongoing risk by minimizing mortgage size while preserving long-term investment exposure. Next, we'll compare the common income-only lens with the more robust net worth lens. On the left, the income-only focus asks whether the monthly payment is affordable today. This approach often ignores asset location, potential penalties from tapping tax-advantaged accounts, and the long-run variability of property taxes and insurance. It can leave you exposed if income declines. On the right, the net worth focus asks how the purchase affects lifetime financial security. It optimizes the funding sources, explicitly considers the opportunity cost of diverting capital from investments, and stress tests for expected or potential income reductions. Billet. With that framing, let's move into tax-smart funding for the down payment. When assembling the down payment, prioritize taxable brokerage assets for the bulk of funds because they avoid early withdrawal penalties. Preserve retirement accounts to protect tax-advantaged growth and avoid penalties or large ordinary income recognition. If you have restricted stock units or bonuses, plan their liquidation against a tax calendar to smooth your tax liability across years. Critically, do not allow the purchase to eliminate your post-closing cash buffer. Maintain at least 6 to 12 months of living expenses in cash for resilience. Now, let's turn to how you stress test the new situation before committing. To stress test, first model the expected post-move income, for example reducing combined income from $200,000 to $120,000 to accommodate childcare. Next, itemize all housing costs: mortgage, property taxes, insurance, homeowners association dues if applicable, and routine maintenance. Build a baseline budget separating essential from discretionary expenses. Add stressors such as property tax growth, insurance increases, and at least 1 or 2 major repairs. Simulate over a 30-year horizon with conservative return assumptions and inflation. Finally, identify failure points, such as required portfolio drawdown rates exceeding a sustainable range, or cash buffers dropping below 6 months. With the process in place, let's ground it with numbers. This table illustrates how a move from a medium cost of living area to a very high cost of living area can affect the monthly budget when income drops from $13,500 to $8,500 in net income. Housing costs rise significantly across mortgage or interest, property taxes, insurance or HOA dues, and maintenance. Child care and essential categories often increase as well. In this example, the post-move budget shows an approximate $1,900 monthly deficit before adjustments, indicating a need for portfolio withdrawals or expense reductions. Next, we'll confirm your understanding with a quick quiz. Quiz time. Which account is generally the best first source for a large down payment to avoid penalties and preserve tax advantages? Option A, traditional IRA before age 59.5. Option B, taxable brokerage account. Option C, 401k loan for the full amount. Option D, Roth IRA contributions and earnings. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, the taxable brokerage account. Tapping taxable assets avoids early withdrawal penalties and helps preserve the tax-advantaged growth of retirement accounts. Loans or withdrawals from retirement accounts can introduce penalties, taxes, or reduce long-term compounding. Now, let's zoom out and evaluate the ultimate trade-off you're making. This decision is ultimately a trade-off between maximizing life satisfaction and maximizing financial returns. Each dollar committed to home equity is a dollar not available to compound in the markets. Conversely, proximity to family support and access to superior schools can meaningfully improve quality of life and reduce burnout. For households considering family expansion later in life, both financial and personal complexities increase, making support networks more valuable. There is no universal answer. The right choice aligns with your priorities and risk tolerance. To help structure the decision, we'll create a mind map of the factors at play. This mind map places the VHCOL decision at the center and branches into financial considerations, lifestyle benefits, risks, mitigations, and alternatives. Under financial, we consider the funding source, opportunity cost of equity diverted from markets, taxes, portfolio drawdown rates, and maintaining liquidity buffers. Lifestyle covers schools, proximity to family, commute quality, community, and safety. Risks include income reductions, property tax inflation, rising insurance, unexpected maintenance, and market downturns. Mitigations include increasing the down payment, guarding housing costs, with guardrails such as keeping housing below 25% of gross income or around 2% of total portfolio annually, using stress testing tools, and maintaining multi-month cash buffers. Alternatives include staying in a medium-cost area, renting in a high-cost area, or choosing a hybrid approach such as buying smaller and upgrading later. Next, we'll apply the framework to a practical case. Consider a household with a $3.8 million net worth and a combined income dropping from $200,000 to $120,000 after the move. They target a $1.1 million home, fund approximately $700,000 from a taxable account, and use a $400,000 30-year fixed mortgage. Guardrails include keeping total housing costs near or below 25% of gross income, or, as a portfolio rule of thumb, holding annual housing carry near 2% of total investable assets. Simulations suggest sustainability if discretionary expenses are trimmed and cash buffers remain intact. The plan becomes riskier if property taxes and insurance escalate without corresponding reductions elsewhere, or if portfolio drawdowns exceed a prudent long-term rate. Before we wrap up, let's do one more quick quiz. Second quiz. When stress testing a VHCOL purchase accompanied by an income drop, which factor is most important to model over 20 to 30 years? Option A, one-time closing costs only. Option B, variability in property tax, insurance, and maintenance. Option C, only the first-year mortgage payment. Option D, vacation budget changes. You may pause the video now to consider. We will reveal the answer in the next section. The correct answer is B. Property taxes, insurance, and maintenance are recurring and often inflation-prone. Over 2 to 3 decades, their variability can materially affect total cost and required portfolio withdrawals, particularly after an income reduction. Now, to consolidate the learning, let's capture the key points and a simple Markdown framework you can reuse. Here's a reusable framework in Markdown form. First, list your inputs. Total net worth in the 3 to 5 million range. Expected post-move income, such as $120,000, and the target home price between $1 and $1.3 million. Next, set guardrails. Aim to keep housing costs at or below 25% of gross income, and target an annual housing carry around 2% of the total portfolio, while maintaining 6 to 12 months of cash. The checklist includes funding the down payment from taxable accounts first, modeling property tax and insurance growth at 3 to 6% annually, including a major repair every 8 to 12 years, and keeping portfolio withdrawals within a prudent band. For the decision, proceed if the stress test passes. If the plan is borderline, increase the down payment, buy a smaller property, or temporarily rent while you wait. With the framework in place, let's summarize the key points. The main takeaways are: prioritize net worth resilience over headline income, fund from taxable accounts first to preserve retirement vehicles, and stress test over 20 to 30 years while modeling rising property taxes and insurance. Maintain cash buffers and guardrails to avoid forced selling during downturns. Finally, recognize that choosing a very high cost of living area is as much about personal values and life satisfaction as it is about pure financial mathematics. Before we close, a brief but important disclaimer. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Your situation is unique, and you should consult qualified professionals who can consider your specific financial details, tax position, and goals before making any decisions. With that in mind, let's wrap up with a concise summary. In summary, many high net worth families can afford homes in very high cost of living areas. But the more important question is whether they should evaluate the decision through a net worth lens, use tax-smart funding, and apply rigorous stress testing. Maintain guardrails and cash buffers to protect long-term security, especially when income is reduced. Ultimately, select the path that aligns with your values, support networks, and tolerance for risk. Finally, here's a friendly call to action. If this breakdown helped you think clearly about the VHCOL trade-off, please like the video, share it with someone facing a similar decision, and subscribe for more evidence-based frameworks. Tell us in the comments what your biggest sticking point is: schools and family proximity, or long-term compounding and flexibility. We'd love to hear your thoughts.